Dean and Tyler Listle are registered investment advisor representatives. Investment advisory services offered through Brokers International Financial Services, LLC, member SIPC. Brokers International Financial Services, LLC, and Secure Retirement Solutions, LLC are not affiliated companies.
It's time for Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. Now, here are your hosts, Dean and Tyler.
Good morning, and thank you for joining us today. Tyler and I will discuss topics that affect your retirement, such as investments, income planning, Social Security, and much more. How are you doing this morning, Tyler?
Doing pretty good. How about yourself?
Good. What we're going to talk about today is risk-managed investment portfolios. That's a mouthful, but yet it's a term that we're starting to hear a lot more about in the investment community. I know us at Secure Retirement Solutions as investment advisors, we have a number of clients that are in risk-managed investment portfolios. And it seems to be anytime we have these people come into our office, they really want to know, what do you mean? What makes up these portfolios? So to better answer those questions and help our listeners understand, we've got a colleague of ours, Andy Osby. He is with a company called Brokers International Financial Services. And what that is Brokers International Financial Services provides the investments for independent investment advisory groups like ours, Secure Retirement Solutions. So we use that company to provide the investments. We also use people like Andy Osby, who we'll be talking to here, to have him put these portfolios together, whether they're risk managed or other portfolios. So he does the buying and selling. He manages. And in our office, what we like to refer to Andy is he is Oz. He's the person behind the curtain. So he keeps the investments going. But a little bio on Andy so you know who we're dealing with here. Andy is responsible for investment design and implementation of Retirement Ally portfolio strategies, consisting of fixed income, domestic equity, international equity, and alternatives. In his current position as Vice President, Advisory and Investment Chief Investment Officer, he's also responsible for overseeing all investment products for Brokers International Financial Services. Andy has 17 years of experience in the financial services industry that include managed account portfolio construction and was previously responsible for overseeing $5 billion in client assets under management. During his experience, Andy has realized the benefits of practicing risk-first methodology. Andy, welcome to the show.
Thank you.
How you feeling down there in Iowa? Andy's located in Iowa, and we always say that he tends to get the weather about a day before we do here in Wisconsin.
Everything's great in Iowa. A little cloudy, but the weather's been nice today. It's probably be about 90, so that'll be your forecast for tomorrow.
Good. We'll take it. I tell you what, Andy, let's just jump right into it. Risk-managed investment portfolios. You know that we use quite a few of those in our office, and of course it depends on the individual client and what they should go into as far as investments. And we go through the financial planning part. We go through the fact-finding. But again, a lot of questions come up. People say, what do you mean a risk-managed portfolio? So that's what I'm going to ask you. What actually is a risk-managed portfolio? Sure.
Thanks, Dean. As we kind of think about a risk-managed portfolio here, really it requires two steps. First part of any risk-managed portfolio is mapping a client's risk tolerance to their return expectations. So if we think about the world of investing or things that we can purchase, fixed income investments tend to have lower return outlooks. They tend not to have as big. You can't make 30 or 40% in fixed income most times. At the same point, you can't lose 30 or 40% in traditional fixed incomes at most times. So if we think about the first step of risk-managed portfolio, it's really to match what that client is looking for over the long term of a portfolio to the risk that we take in order to get returns. So if we think about it in simple terms of an S&P 500, that's quite a bit of risk that you take on in order to get the returns for that. If we think about it in buying a core bond, not a whole lot of return for the risk that you get. So we want to match those two together to match up with what the client's looking at. Traditionally, we would look at that in a 5-model type of an approach, anywhere from a conservative investment all the way up to an aggressive investment.
Okay.
The second side, sorry.
No, go ahead. I was just going to say, you refer to fixed income. What exactly is fixed income in a portfolio?
Sure. So fixed income in a portfolio would be a bond. Treasury bond could be a corporate bond. So if we think through exactly what that is, several different varieties, but the United States government issues treasury bonds that either last from 30 days all the way out to 30 years. Those types of bonds historically pay dividends or interest that you can get off of those individual bonds, coupons, that average about 2.5% to 2.5% right now. If we think about buying those, you're locking into something that makes 2 or 2.5% for the next 30 years. On the same side, you can add a little more risk to that and buy a corporate bond. So you could buy something that would be similar to, say, Apple. If Apple issued a bond, there's a little more risk to that than a guaranteed treasury bond. So Apple may pay out 3% of an interest payment annually for the next prescribed period of time, anywhere from 1 year to 30 years. Okay. Lastly, there's kind of a municipal bond. Those have their own type of advantages. Municipal bonds can be tax-free from a federally tax standpoint, but they're issued by municipalities, local governments within your state or across the country. Those are just direct definitions of what bonds would be, or fixed income, if we think about it that way.
Okay, really good. And as the Chief Investment Officer, you determine which of these investments go into the whole complete portfolio for a client, correct?
Correct.
Okay.
And part of that is then taking, once we set that first step, to assess a model around a client's expectations or risk tolerance for what they want. The second step of that is then managing that model, which is also a risk-managed feature. So if we choose a moderate model, which historically is probably somewhere in the neighborhood of 60% equities, things that can make and lose money at a higher rate than fixed income, and 40% fixed income, if we look at that percentage, every given day, we look here at what things we need to do in order to increase performance or reduce risk for that client. So if we're in that moderate model and we use just those simple numbers of 60% equities, 40% type of fixed income, that can vary. We can add or subtract equity and fixed income depending on the market and depending on the market conditions to really align or add return to a client's portfolio over time.
Good. Okay, so we sort of know what a risk-managed portfolio is. Why were they created? Because, again, just a handful of years ago, you really didn't hear too much about risk-managed investment portfolios that are in the market. Why were they really created?
They were created primarily because over the last, now we're in 2017, so over the last 17 years, we've had really two big market corrections, one in 2000, one in 2008. And in 2000, we had a tech bubble that, quite honestly, we didn't hear a whole lot about risk-managed portfolios because we didn't have a lot of the investment vehicles that we do today that have been created since 2008 or the financial crisis that we had that have allowed people to start to look at managing things in a risk-managed way. I think also with that, what we've experienced in the last, since 2008 until now, 2017, over the last 9, almost 10 years, we've experienced a straight-up market. And we haven't had a whole lot of downside correction, but a lot of people remember 2008 and what they lost in their portfolios up to 50, 60% of their portfolio value. And so why risk-managed portfolios matter now, or why we're starting to see a bigger trend move in that direction, is because it's just as important how much we can protect on the downside of a portfolio as what it is that you make on the upside. If we think about that direct correlation, in that if you have $100,000 and you lose 50%, So it goes down to $50,000, which a lot of people had happen in 2008, in order to break even. You don't have to make back 50%. You have to make back 100. And so as those portfolios or as investment vehicles have become more wide-ranging and more popular to use, it's become more of a standard, or more things that you're starting to hear is that if we can protect and not lose 50% on the downside, but maybe lose 20 or 25, we don't have to make back 100. We have to make back somewhere around 30 or 40. So the more we can protect on that downside, the better.
Good point. Ty, do you have any questions for Andy that you think our listeners would want to hear?
Yeah, so Andy, you mentioned that in the early 2000s, risk-managed portfolios really became more popular. It seems to me that before that, passively managed portfolios were the new thing, or were the thing at the time. So how do risk-managed portfolios compare to a passively managed portfolio?
In passively managed portfolios, they've really been around since ETFs, exchange-traded funds, have become more popular in usage with companies that are now offering those types of things at lower costs. That has really driven the passively managed portfolio concept. There are more ETFs today. There's more ETFs created every day by every company that's out there that helps lead more assets towards passive. And the difference between passive and risk managed, to me, is if we think about in the early 2000s, the word that we started to see come up a lot was asset allocation. And that's kind of the first thing that led to risk managed portfolios. But in theory, passively managed portfolios are you buy an investment today into 9 times out of 10 low-cost exchange-traded funds or low-cost index mutual funds. And what you buy today, you still own in 10 years, or you still own a year or two from today. Passively managed portfolios, you buy to your exact risk tolerance that you're trying to get into, and it doesn't change with market conditions on a day-by-day or month-by-month basis. In what we've seen, the difference between passive and risk-managed is that in a passive environment, if the market performs really well, you don't need the downside risk management. So if an S&P 500 is performing 20% a year and you're buying into a passively managed portfolio, during that up market, that passively managed portfolio is going to perform really well. The downside is, on the passive side, when the market loses, you're going to lose along with that market. Mm-hmm. And where we've seen that difference to risk manage is during volatility, market downs and ups, as that increases, risk managed or changes that we can make to a portfolio over that year definitely positions the portfolio to take advantage of inter-year, inter-month changes that we've seen come up. So we try to blend the two here in that we use low-cost investments that are commonly used in passive managed portfolios, and we use those low-cost investments to fund, where possible, our risk-managed strategies. So we can take advantage of low-cost solutions that are available out there, exchange-traded funds, index funds, but then we map them with things that are more active and not necessarily just index-based investing, where traditionally passive managed lives.
Okay. As an aside here, I just want to let our listeners know, if you have any questions concerning risk-managed investment portfolios or what Andy has to say or what we have to say, you can give us a call at 920-347-9888. We're located on Allied Street in Green Bay. Or you can get our contact information or follow us on Facebook. My Facebook page is Dean Listle. That's Listle, Secure Retirement Solutions, or Tyler Listle, Secure Retirement Solutions. Or you can go to our website at srsplans.com if you would like some information from us regarding Andy's talk here on risk-managed investment portfolios. Andy, one other thing here, with Secure Retirement Solutions, our business very well. We deal mainly with pre-retirees and retirees, those people who are aging into the time period in their life where they start to say, hey, you know what, I've got another 10 years or so before I retire. We get people in their 50s, 60s, 70s, and 80s. But as people start to age into retirement, we're seeing more of them desire risk-managed investment portfolios, and they're suitable for them. The question I have for you is there a certain age that risk-managed portfolios are best suited for?
Thanks. I would say risk-managed portfolios are best suited for all ages. I don't think there's an age in which it's not a suitable investment. The one thing I would say about risk-managed portfolios is we're always trying to manage the downside of the market along with the upside. If a client is looking to be really, really aggressive in what they get, maybe risk-managed isn't where that would fit. And quite commonly, that's probably someone in their mid-years of working ages, 30, 40, maybe early 50s, that tend to be the clients that I hear about most that are looking to take more risk. But I think it's suitable for every age. More specifically, I think it's really suitable or gets into its key niche for clients near or in retirement where the downside of the market and how much you can protect as you're living off of your retirement assets becomes much more important. If you are taking a 5% distribution out of your account, always we want to make as much as we possibly can. But if you take a 5% distribution out of your account and it loses 20 or 30%, that really affects someone near retirement or in retirement as they're taking that income. So I believe that risk-managed portfolios really specialize in someone in that age group that's near or in retirement and what we can do to provide returns and also protect on the downside. But I would also say that it's really suitable for anyone who doesn't want to really experience the roller coaster of a market to what it potentially could be. Once again, back to the last 17 years, we've experienced a couple cycles where we've lost 50 or 60%, and the more we can protect on that downside, the less you have to make on the upside. So, in summary, it's good for all ages, but really specializes and fits within that near or in retirement group.
Okay. Tyler? Okay, I'm going down a list of some questions again that I think our listeners want to find out about the risk-managed portfolios, and I do know that in these portfolios, because again we do have a number of clients in them, it seems to be if the market gets a little, I refer to the term queasy. The market gets a little bit queasy, starts going sideways. There's some uncertainty out there. I do see that you'll go in the portfolios. And it's, I'm sure, based on whether it's a conservative, moderate, or aggressive portfolio. I do see at times some positions being sold off and cash is being built up. And it seems to be this is being built up before the market actually does go down. So you're building cash when the market is relatively strong but maybe stale. What is the reason for building cash in these portfolios at certain times of the year?
A couple different points there. Cash is always an asset class that we would look at holding within these portfolios for several different reasons. One of them being if a client is near or in retirement, if we hold a little cash off to the side, it helps facilitate cash distributions that you would take to fund retirement. So we're not having to sell parts of our positions in order to fund retirement income. So good cash point. In its existence, between 2 or 5% of a portfolio makes a lot of sense just to fund retirement distributions if we think about it that way. As the market moves or as things become less advantageous to purchase, that cash position can rise, much like you mentioned there, Dean. Right now, most of our portfolios hold roughly between 8 and 10% cash. We can hold, by what we manage to, up to 50% in cash. That type of cash position is not a normal type of thing that we would hold, but if a market environment occurred like in 2008, we could very easily get there to help protect downside. The good part of cash is it doesn't lose money. The bad part of cash is it doesn't make money either. Mm-hmm. So if we think about where that's at, we're really using it as a protective downside measure as those cash assets are increased. Right now, we're a little above our target of 2 to 5% because fixed income investments have been they've not performed well in 2017 and late 2016, and that's primarily just due to what the the Federal Reserve has done to the Fed funds rates and rising interest rates this year. Just a quick summary on that. If interest rates are rising, it's kind of a cyclical market where if interest rates go up, bond prices go down. So you lose money on your bond investments as interest rates rise. So we've taken an opportunity to pull a little money, a little extra cash, and add to the portfolios because fixed income just hasn't performed as well. We can move that money within the portfolios from a risk management standpoint to equities or whatever we're trying to do as well. Right now, with the market prices and where they're at, historical highs and what we've seen, there is opportunity there, but we're really trying to take that extra cash position and use it as an alternative to fixed income. And that's why our cash positions are where they're at today. But historically, 2 to 5%. We can manage up to 50, and really to get to 50, we would have to see a year like 2008.
Okay, that makes a lot of sense. Tyler, do you have any questions here for Andy?
Yeah, Andy, when we talk about risk-managed portfolios, a lot of our clients ask the question, they want to know, well, what kind of investments go into it? Could you just fill our listeners in on what kind of investments you look at using within a risk-managed portfolio?
Sure. We think about risk-managed portfolios, and really to kind of sum that up from the very beginning, we look at equities in all positions, whether that's U.S. Large cap, U.S. small cap, U.S. mid cap. We look at international, whether that be Europe, that could be anything internationally as we would look at that. We look at emerging markets. That would become countries like China or those types of things, where if there's advantageous parts of the market, we're going to take advantage of that where we can to get returns. We also look at areas within fixed income. So we mentioned earlier corporate bonds, municipalities, treasuries. There's also several different types of fixed income investments that can be used. Those fixed income investments, as an example, could be high yield bonds, things that perform better but are rated lower, more risk of default. We can look at preferred securities. We can look at floating rates. Those are types of fixed income investments that may be more aligned with the market. So if we think back to risk-managed portfolios, what we're trying to do essentially is buy into areas that have a chance of outperforming a general index of what we're looking at over time, in the short run or over the next year or two. And in doing that, there's a lot of different investments that are out there. The easiest thing that I could probably say is right now there's about 27,000 mutual funds that clients can pick from. And there's roughly about 1,000 exchange-traded funds that can be picked from. So there's a lot of options that are out there that really specialized in certain things. At its core, we look at a fixed income, equity, international equity type of environment. But just to hit on the last part that Dean had mentioned right up front is the alternative investment standpoint. Where necessary or where we can, there are investments out there that take advantage of downsides of the market. There's investments out there that take advantage of U.S. equities that may lose money. So depending on the time, there's a lot of different levers that we can go into. At its core, we're looking at fixed income, equities, international, and some alternatives. And we're looking at that in an active mutual fund environment. We're looking at that for investment vehicles. We're looking at it in an active mutual fund environment. We're looking at ETFs, exchange-traded funds. We do use those as well. And we're looking at some of those alternative investments that are publicly traded on the stock exchange.
Okay. Again, if you're just tuning in, this is Andy Osby. He is the Vice President of Advisory Services and Chief Investment Officer with Brokers International Financial Services. They provide investments and portfolios to independent investment advisory groups, a lot like our Secure Retirement Solutions. If you have any questions as it relates to Andy's conversation, you can give us a call at 920-347-9888. We're on Allied Street in Green Bay. Andy, as we're starting to come to a close here, we have a couple minutes. I just want to know right now, based on market opportunities, I mean, we're in the middle of summer. We've got a little bit of a stalemate politically with getting some agenda items through the Senate. What market opportunities do you see coming up for the risk-managed portfolios? What do you think that here in the United States we're going to be able to capitalize on from an investment standpoint?
Sure. So if just from an overall economic standpoint, I think you've hit on the key issues there that we're paying attention to on a daily basis, which are some of the geopolitical issues, I would say, which are probably taxes, tax spending, health care bills, and infrastructure spending. Those are the big three things that we constantly hear out of Washington. All three of those have an effect on what market opportunity will be there and what that looks like. Opportunities for me, if I think about 2017, the first quarter of 2017, we had very, very strong corporate earnings returns, which is very indicative of a strong large cap U.S. market. And so far this year, we've been overweight in our portfolios in large cap, mid and small domestic U.S. securities. If that continues, and we'll watch it cautiously as the second quarter has now ended and we're seeing corporate returns, if that trend continues on the same path it did in the first quarter, I would believe that we're going to come into for the rest of 2017 and have strong U.S. returns. And that's something that we're really at its core watching. Issues that may come out of Washington from different bills, those are things that we'll continue to watch either for an opportunity or to risk manage away from. So if we think about small cap U.S., small cap companies in the U.S. are probably companies that will benefit the most from a tax reduction or a bill that could be passed. If that doesn't come to fruition, then we would look to move away from small caps. If it does, then maybe we would increase that position from where we currently are at. So if we think about those as specific examples, we're looking at both a core fundamental, what are these companies returning from profits, and we're also looking at regulatory changes that may affect them. Overall, then we would also look in a risk manage for an opportunity that healthcare companies, things in that type of sector, could really benefit from a healthcare bill or what we could see from profitability. We also seen at the end of 2016, after the election, financial companies in the large cap space really gained a lot of money. Now they have kind of fallen back a little bit. So we're always looking for opportunities in a risk managed environment where policies or different things that could come up would benefit a portfolio, and we look to add those or subtract them, depending on what the market looks like at that time. For the rest of this year, I would say that I'm still positive on what domestic equities can do, U.S. securities, still positive on what international can do, less positive, as I kind of mentioned on the fixed income side, on what we can get in fixed income returns if we keep seeing a rising interest rate.
Good. Andy, first of all, I want to thank you very much. Tyler and I want to thank you for coming on the show today. We hope our listeners find this valuable, good information. If they have any questions as it relates to anything you discussed or risk-managed investment portfolios, you can go to our Facebook page and get our contact information at Dean Listle, Secure Retirement Solutions, or Tyler Listle, Secure Retirement Solutions. And that's all the time we have today. We hope our listeners enjoyed it, and you'll come back to listen to us again next week. Thank you, Andy, very much.
Thank you, Andy.
You've been listening to Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. To get more information from Dean and Tyler, contact them at Secure Retirement Solutions on Allied Street in Green Bay. Call 920-347-9888 or visit them at srsplans.com. Securities and investment advisory services offered through Brokers International Financial Services, LLC. Member SIPC. Brokers International Financial Services is not an affiliated company.